Please note that any advice contained in this presentation is general only. It doesn't take into consideration your personal circumstances, and you need to decide for yourself whether it's appropriate to you. Any reference to past returns are not an accurate indicator of future returns.
Hi, Ivan here. In this video, we're going to talk about bullish spreads. We're going to cover what is a bullish spread, a bull call spread, a bull put spread, the difference between a bull call and a bull put spread, and comparing spreads with implied volatility. So far, we've had a look at the long call, and that's really been the predominant strategy that we used for bullish trades. Now we're going to look at the bull call spread. A bull call spread is when you're bullish and you have a target in mind. It's also known as a long call spread and a vertical spread, and it's a modification of the long call. With a bull call, you add a profit target for your trade. The idea behind it is that it's unlikely that the stock is going to go to the moon in the next 30 to 45 days. Let's have a look at the trade. We give it a 40% difficulty rating because it is a little bit more complicated than a in-the-money or an at-the-money call trade. You run a bull call spread when you're bullish and you expect that the price is going to go higher from where we're at the moment, and you have an idea about roughly where the level is going to be. The best thing about it, very much like a long call spread, is that it provides protection if your view is wrong. Because we're buying one option and selling another option, we're neutral to volatility. We have a limited maximum profit and a maximum loss. And the way we calculate this is the difference between the two strikes minus the cost of the spread is going to be your maximum profit, and the maximum loss is going to be the amount that we've paid for the spread. As I've mentioned, a bull call builds on a long call by adding a profit target to the trade. So let's have a look as to how we set it up. We buy an at the money or an in the money call, and we sell an out of the money call of the same month. The idea is you're reducing the cost of the bought call with a sold call, which ultimately reduces the cost of the trade but limits your upside. However, the reduced cost also means that you can increase the trade size, so you can increase the amount of leverage that you put onto the contract. And the sold call decays to offset the time decay in the bought call, so you actually get a much better break-even value. So let's compare the long call to the bull call spread. So what I've done is I've created a BHP long call and a BHP bull call spread in the same month. The difference is obviously we've sold a 35.50 to offset the 34.50 BHP. The maximum loss is going to be about the same. So you'll notice is that although we've put on the quantity of 20 versus 10, the maximum loss is about $800 in both cases. However, because we have got a spread on, we have a maximum profit of 1,150 for the bull call spread, and it's unlimited for the long call. However, our break even for the trade is 34.92.5 versus 35.30. So we get a significantly better break even on double the quantity versus the long call. So if the bull call is so much better than the long call, when would you not trade it if you're bullish? Well, almost always you would go for a bull call spread over a long call. The only times you wouldn't is if you are extremely bullish, so you don't think that there is a $1-2 range. You actually think there's significantly more room to move in a short period of time. Also keep in mind that the spread costs more brokerage to execute, as there are two separate legs that need to be traded instead of one. You also want to have more premium in your sold leg than the brokerage value, because you want to ensure that there's actual value in selling that option, that you're not limiting your profit target for no reason. Okay, so we've had a look at the long call, we've had a look at the bull call spread. Now let's have a look at the bull put spread. And the bull put spread is what you put on the bull put spread when you're bullish to neutral on a stock. It's also known as a short put spread and a vertical spread as well. A bull put is a modification of the sold put. So with a bull put spread, you buy a put below where you'd normally sell your sold put for protection, so that if you're very, very wrong, you are limited in the amount of risk that you've got on. As a result, the payoff becomes very similar to a bull call spread in the way that it's drawn. Now, where you pick your strikes is going to define how your risk reward looks. But if you pick the exact same strikes between a bull call spread and a bull put spread, you'll actually notice that the payoff should be pretty much the same due to put call parity. Also, most brokers will not allow you to sell naked options, i.e. unprotected options. So if you want to sell a put below where the price is, for example, you will need to implement this spread. Let's have a look at this. So because there's now a little bit more complexity involved in the spread, there's a 50% difficulty on this, and you run this again when you're bullish or neutral to bullish. And depending on where you pick your strikes, the impact of volatility is going to be different. So if you pick it at the money, so you sell the same strikes as you would with a bull call spread, you're going to be neutral to volatility, or it will impact you a little bit differently at different times. And you can see this through a payoff grid. However, in the case of an out of the money bull put spread, you would actually like volatility to drop. Also, if the share price is above point B, you're going to have a positive impact from time. If it's below A, you can have a negative impact from time. In this case, there's a reversal of maximum profit versus maximum loss. The maximum profit is going to be limited to the net credit that you've received. The maximum loss is going to be the difference in the strikes less the net credit received. For an at-the-money bull put spread and at-the-money bull call spread, these are going to be roughly 1-to-1. As you start changing your strikes, you will find that maximum profit can be as good as 2 or 3-to-1 versus a out of the money bull put spread. You might be seeing it as sort of 1-to-5, depending on how likely it is that the strikes are going to get hit. So depending on how much delta there's going to be in the trade. There are two common ways to set this up. So typically you will sell the spread out of the money, as I've mentioned, and you'll want to make the most out of time decay, thus making it a neutral to bullish strategy. So you want the stock to end up above strike price B in the payoff diagram. However, your risk reward ratio will reflect the higher probability of profit. The further out of the money you sell the bull put spread, the less favorable the risk reward ratio will be. The other way to put on the trade is to use the same strikes as you would with a bull call spread, and as I said to you before, this will yield similar results. So let's take the example of BHP again, trading about 34.50. And we've got an out-of-the-money BHP bull put spread and an at-the-money bull put spread. So we've picked a 35.50 and 34.50 as we did in the previous example, and we've also created an out-of-the-money bull put spread, which is 33.31.50. So you will see that the maximum profit and the maximum loss change dramatically. You have a much less favorable risk-reward ratio. However, your break-even is significantly different. So from here at 34.50, if you're trading an at-the-money bull put spread, you need the stock to go up to about $35, so about 50 cents from here to be break-even on your trade. However, with the out-of-the-money trade, you just want to make sure that it doesn't fall more than $1.70 or so. So let's compare the bull call versus the bull put, assuming that we're picking the same strikes. And there's several key differences between the spreads. One, the margin. The bull put is going to have a margin as it is a credit trade, whereas a bull call will not. Brokerage on expiry. If you are right, you will not need to pay anything to close the bull put spread, as both legs will expire worthless. Whereas with a bull call spread, you will have to close down your trade, as ideally both of the legs are going to be in the money. The buying power. The bull put spread will likely require more capital. This is in particular true if you've got margin multipliers or margin buffers associated with your trading account, which most brokers will charge you. Typically, if 5-year rank is high, you want to be trading bull put spreads and probably out of the money bull put spreads to make the most out of the high volatility, and you will ultimately be a net seller of options. If 5-year rank is lower, bull call spreads tend to be better as you are a net buyer of options.